So I'm not really sure if we're going to do a real estate panel or comedy hour based on my next three guests. But very fortunate as we explore real estate as an asset category. This is oftentimes very overlooked because the wealth managers inside of the Wall Street firms typically do not know how to execute individual real estate strategies. So they steer away from it for a variety of different reasons. It's super great to have you. Little kind of behind the scenes is in classic Jim Harrison. He rolled in right when we were about 30 seconds removed. So listen, I guess the first question that I want to kind of pose is, the crisis, and y'all represent different sectors of the real estate world, and so kind of talk quickly about what you're seeing out there in terms of how you're dealing with the particular crisis. We'll just start with you, Jim, and work to your right.
So the markets we're in, Arizona, Utah, New Mexico, all different types of industrial buildings, many different tenants, from truck terminals to distribution centers to small mom and pops. I almost feel guilty being on this panel because my life is really not that bad. We collected about 97% of our rents in April. I think we'll be about the same in May. And yet when I talk to my counterparts in retail, that number is below 40%. So our buildings weren't shut down. Our tenants are still working in these buildings. That doesn't mean that their businesses haven't been impacted, but for us, we're a very boring, steady Eddie asset, and we've continued to work with the tenants that we have to, but for the most part, they're all paying us, and certainly after they got their PPP loans, they became, they want to pay. They're not trying to ditch out on the leases. How about you?
Well, when we started the WDP Partners organization about 17, 18 years ago, about 100% of what we were doing were large regional retail centers. We've been fortunate, not smart, but lucky that we sold most of those projects about a year, 2 years ago. So we just got lucky. So what we've been doing mostly the last couple of years is doing self-storage. And just like Jim, we've been really blessed to own self-storage throughout this downturn. It's one of those asset types that does very well when there's trouble in the economy. Just like the last downturn, it's performed probably the best or close to the best out of all the asset types. And people keep needing space, whether they're downsizing or moving in with their folks or whatever. People still rent storage units. So once again, it's better to be lucky than smart. It's kind of where we're at right now.
Yeah, and I think in multifamily, similar facts in that when people are not taking on long-term risk buying homes, or maybe moving in with family, sort of downsizing, you start to see less movement to sort of the luxury buildings and things like that. And so the really well-located, affordable housing really allows you to essentially, keep the rents flowing, and that's what drives these income investments. And so, maybe they're coming out of a single-family home, putting their stuff into storage, and renting an apartment, and that's typical. And if you go back to the 80s, the 90s, the dot-com crashes, 2008, 2009 transition, where multifamily has historically, rents have always been stabilized. And so I think that's really one of the opportunities, is to have a perspective on, you're buying the income versus the sale price of an asset. And so you'll see values go like this in what capital is available in multifamily. But if you're underwriting the programs and the investments in a way that it just is, as long as the rents are being serviced, you can essentially grow the revenue over periods of time. I think right now, though, is you start looking at the renter jobs. And so those that are renting, were they in hospitality? Were they in retail? Were they in the restaurant business? And so that's where some of the multifamily is seeing issues. It's far less than what we thought it was going to be in terms of impact. Rents are being paid. There is some relief that's available to these residents. But where I see some real opportunity is when you're talking about a multifamily investment, you're trying to grow the revenue. Whereas innovation right now is the owners of these apartment buildings can now think about how do we operate with more efficiency, work from home? Do we need as much space for the corporate office, these types of things? And so they can be creative in figuring out how to continue to grow the rents and the revenue without putting the pressure on the renters who right now I would suspect are not getting rent increases. Just not a good time for that.
Question, why real estate? I mean, I've just spent last week and so far this week talking about stocks and bonds and cash and an allocation. Why would an investor want to own real estate, and whether it's industrial or self-storage or multifamily?
I guess I'll take that on. I think that this is not a get-rich-quick business. We are very long-term investors. The only smart thing we've ever done is not sell anything, and we've hyper-amortized our principal paydowns to where today we've got very good flexibility with, maybe 30% free and clear, another 30% that'll term out in the next 3 to 5 years, and another 30% that might be 50% leverage. So if there is a situation at the end of the summer where some of this grade B and C industrial starts to trade, we just bought something last week that we had to go non-refundable to open escrow, $200,000, and bought an asset that was underpriced, but they had to sell it, and we bought it in a 30-day time frame, which is pretty unheard of in today's COVID world. But we're in a spot now with this portfolio where we can do that. But it's taken a lot of discipline for virtually my whole career of 30 years to buy these things right, pay the loans down as fast as we can, and not re-lever them and pull money out and sell them. And unfortunately, when you sell them and do a trade, you're buying something unknown and selling something known. For us, I've had people criticize the portfolio of buildings we own that there's a hell of a bunch of windbreaks. Well, maybe that's true, but they're all leased, and there are companies making money and using them in their daily business. And you never stress test your portfolio for something like COVID, but as it's worked out, this has been a remarkable asset class. And we've kept these tenants in a variety of different businesses in 3 states paying us. But it's not a get-rich-quick thing at all.
Yeah, and I think for multifamily, what I like about it, and I love the way your strategy is, I know you and I haven't spent as much time together, but having that strength, coming into a deal with a position of strength, knowing that you're not forced to make a decision when that cycle goes, and you're still being able to kind of keep those rents in place and stabilize the asset. It's certainly, there's no better, I think, investment. I'm not giving you investment advice, but I can tell you that the people that benefit from these long-term operate in a position of strength. In other words, we've purchased large portfolios from public companies that had made quarterly promises on returns, and so they had to exit, and so they're in a situation where they're not in a position of strength. We've come in at a low basis and been able to stabilize and pick up opportunity. I think a lot of those types of things are going to shake out when companies are going to look at, where do they get their cash and those types of things. But I think it's really, again, coming back to, in multifamily, you're doing month-to-month leases, 6-month leases, 12-month leases, and so you can reprice a portfolio and a building very quickly without being committed to long-term commitments. In other words, if I were financing a car dealership today for 25 years and one tenant, single tenant owner in a building with autonomous driving vehicle and all these sort of unknowns around what's happening around the future of the way people buy and sell cars, I might be at risk to understand what's the likelihood of having an unfavorable event. And so with multifamily specifically, you can be flexible and reprice buildings and work with your residents in those ways.
How about the storage guy?
Well, I think the classic answer is why you'd want to do some real estate or invest in some real estate in addition to stocks and bonds is just the diversification. I mean, that's pretty obvious. And a lot of times real estate can perform a lot better in a downturn, interest rate hedge and whatnot. So, but I think our strategy and how we've raised money over the last, 15 years is that, we've told people we're in for the long haul. All of our investors know that we're in for the long haul. So it's a typical 7 year time frame. But we're also very opportunistic. So if the time's right to sell, we'll sell. If the time's not right to sell, we'll just hold. We're lucky enough for our investors, aren't looking for their money back real quick. I mean, they know the strategy that we're employing. So I just think being able to be flexible, to sell when we need to sell and hold on when we need to hold on has been great for us.
I've done a lot of business with Jim and Todd, and to further amplify the question, it's really cash flow. We're the challenge that we have in the allocation today is how to create cash flow and stability at the same time. That's why real estate, I think, on a going forward basis is going to be more attractive, because it has that income component that can generate consistent cash, provided the risk controls are in place. So next question is, Jim, you've been doing this 30 years, and Todd, you've been doing it for a long time, plus your father was part of, Westcor. And let's just talk about risk controls, because, how do people screw this up, and then how do people get it right? Because Phoenix has been a boom bust cycle, and you clearly have seen guys get rich in the boom cycles and then get completely laid away. So walk through kind of your program in terms of risk controls, and how do you manage risk when something like COVID happens, or the downturn of housing and all of that?
So for us, the last 6 weeks has been about debt. We've never borrowed this cheap. I think we've put together, más o menos, $125 million of debt with 6 different life companies. That's averaged from 285 to 325, with very relatively short amortizations, but 10 years fixed terms. So we've never borrowed at those kind of levels. We might have a 20-year amortization, and now we're at the back 10 years, and so we're just taking those principal amounts and amortizing them over the remainder 10-year period, but at ridiculously low rates. And so for us to kind of lay in the weeds and let this thing play out over the summer, maybe there'll be opportunities, maybe there won't. But one of our little secret sauce things is we've never gone outside of our fairway. We pretty much, industrial is our asset class. We don't play in office or retail or anything else. And that served us well. And managing the debt for us has been the goal. And we've got many partners that are family offices that are really looking to manage those income streams into the next generation. They know they're predictable. There isn't risk that the family office is taking on the debt side. And so these assets can be and generate income for a very long time, which, everybody's got a different theory on whether or not you give the second and third generation piles of cash. But at least for my guys, they want to have income streams that they can manage when it's age appropriate, and not necessarily have big piles that they're dumping on the next generations.
I agree with Jim. Like I said, we did, for the vast majority of our existence, we've done all retail. We've gotten out of that a little bit to do some other product types, but very few. We kind of stick to what we're good at, and knowing that there's a lot of other players out there that are better at different product types than we are. For instance, apartment buildings. Over the last, how long has it been? 10 years, they've had an unbelievable run. Right. We've had a lot of people ask us to get involved in apartment development, and we just know there's just too many other people out there that have the experience to do that, and trying to learn from scratch, we just lose a lot of our competitive advantage. So stick to what we're good at. And I think the second biggest thing for us is that we've really stuck to investing in Arizona, and we know Arizona like the back of our hand. My partners have been doing real estate development in Arizona for 50 years each. So in Arizona, we feel like we've got a competitive advantage from knowing all the politicians, knowing all the consultants, knowing the area like the back of our hands. So we're good. We're good here, and if we start to venture other places, we're concerned that without the right JV partner, we're losing all those advantages. There's just people, there are developers all over that just know their area a lot better than we do. So we're going to stick here for the time being.
Yeah, and I think it's interesting. You're talking about risk, and it's really a number. It's a lot of people look at it like that emotion of what happens when, and the reality is, and I think the banks get this right. They factor in when everything goes bad into probably the package that investor would be looking at. But if you think about how much time you spend indoors, maybe you're watching this indoor. You're probably at home, at an office. Maybe you're in the car. You shouldn't be driving while you're in the car, but maybe you're in some kind of structure, right? And you're either at work or in some kind of a real estate environment. And then you have your phone. Think about how much time you spend on your phone, the technology. And so when you bring the two of these together, I think that's really where the sort of risk mitigation is happening, is the opportunities that are coming towards real estate in terms of operating more efficiently in the transaction, simplifying the transaction, allowing investor owners to keep more of the cash that's generated, creating a frictionless, seamless experience for people that want to rent. You've seen this with the airlines. You have to go to the gate agent. Now you can just get a ticket right on your iPhone and wand right it back in. And so you're seeing a lot of innovations that are going to open up capital, open up opportunity for all of real estate, really. And my biggest thing, when I look back at the automobile, 30 years ago, the automobile, think about your car 30 years ago and then think about your car today. I mean, it can drive itself, right? Like my car will get me back in the lane even if I don't even do it. And so real estate's coming with that type of innovation. You're seeing partners that are integrating with real estate to advance that. And I think when you think about investments and what's going to happen next, a good leader will understand what's happening next, what's happening with innovation and technology, and then that's going to ultimately, I think, in my perspective, understanding the customer, reducing any kind of risk that would put on any kind of financial instruments in place.
So leverage. So I have just a personal experience. We had two projects in San Francisco. One was down by the Transbay Terminal, which was close by the new Salesforce building. And then the other one is in an area called Upper Market. One of the sites was a B site, one was an A++ site. The B site, we didn't have a lot of leverage. The A++ site, because it was an A++ site, had a lot of leverage on it. And the general partner who managed it was sure that everything was going to work, and then the downturn happened. And one of the things about real estate, which is a challenge, is when the downturn happens and there's a possibility that you can lose your cash flow, your cash flow could be impaired. Ultimately, what does that mean to the project? Painful, because the project that was in the A+ location, we lost it because the partners weren't willing to continue to service the debt during the downturn because they were suffering in all other aspects of their portfolio. The project that was in the B location didn't have a lot of leverage, so it had tremendous staying power. So as the market came back in San Francisco, we sold the B location for a lot of money. Let's segue into the next. So how do people, and this is where people get confused, they see you guys up here and you're talking about industrial self-storage multifamily, and they're like, well, how do I access it? So there's really two methods. One is direct ownership, where you can actually go out and buy multifamily or buy buildings or buy retail or self-storage and hire the team and do it yourself, or you can access the Jims and the Todds and the Patricks through a partnership. So next question is, what does a deal structure look like? Like, what does your structure look like? Talk about that, but then also talk about things that investors need to think about when they become a limited partnership in somebody else's deals. Like, what have you learned? Because you've seen lots of good and bad. And there's been a lot of operators that we all know in common that have come and gone. And so, Jim, can you kind of, one, speak to kind of your structure and what investors that come into your program look like, and then what do structures look like in general, and what do people need to look out for?
Well, you know, real estate to me in everywhere is a local business, and you need to be tied with a local operator that knows that business better than anybody. And whoever that guy is that is doing industrial buildings in Sacramento or Denver or wherever, you know, it'll take a little bit of research, but find that guy that is the expert, that is, one, honest and well recognized in his industry by the brokers, by the lending community, so that he can execute. In our world, when I started out raising money, we were paying a 9% preferred return and then giving 75% of the ownership to the partners, 25% to us, and then we took a small management fee for running the assets. The management company, at least for us, breaks even. We don't make any money on it, but we do all of our own third-party work. So we have very good control over Sunday morning. I got a flooded parking lot. It's my own crews that are out there pumping it out. I'm not relying on outside people. Even in Utah, down to snow removal, we do all our own stuff. So over time, you know, we went to 8, then we went to 7. Today we're at 6. We always try and put at least 40% equity in the deals up front, hard cash, and hopefully we're buying an asset below replacement cost so that we're not forcing the bank, which could include a guarantee from me, to take a big risk. For us today, it's a 6% pref off the top of the income, and then 75% after that goes to the partner, 25 to us. So it's for me, it's really got to be able to show that you're going to make a 13 to 15% return, or there's no reason to do it. So a perfect deal for me, for example, would be a guy gets 6% off the top, then he gets 75% of the cash flow after that, which hopefully is another 6, and then he gets another 3%, let's say, of the 75% of the principal being paid down on that loan. So his overall return, we add those 3 numbers so that he would have a 15% overall return. Not every deal works like that. Sometimes it takes a little longer to lease up. Sometimes you gotta, you know, we don't do a lot of new construction. We do some, but I much prefer buying assets because I know what the leasing market is the next day. I'm not the guy to buy a site and hope like hell a year from now you got the same kind of market. We'll do it, and we do it in places where we have a very constrained land inventory, but that's not my favorite thing to do. And I'm not the guy, you know, everybody talks about Amazon, and I think in just about every market in the country, if you take Amazon out of the absorption numbers, the industrial absorption has kind of been tepid all over the country. Amazon is a machine. It is feeding all aspects of the business. And for me, that scares me because somebody's going to be a competitor to Amazon. And, you know, they may be gold-plated credit today, but 10 years from now, it may change. And you're left with an asset that you might have paid $300 a foot, that when you get it back, it's worth $100 a foot. So we always focus on price per foot when we go in.
I would agree with Jim on if you're going to invest with a real estate company, I think it's almost 100% is track record and reputation. You really got to do your homework on that and find out, you know, talk to local people, find out how they've treated their partners in the past. I think that's a good, it gives you a good idea on how they're going to treat you. Talking about specific deals, I think these guys would agree. I mean, they're all over the board on how a company's doing. Depending if you're if you're going to invest with an institutional real estate company or if you're going to invest with, you know, a smaller group like mine. You know, I don't know if this audience even understands what the preferred return is, Walter, but you know, what we have done is an 8% preferred return, which means all the investors are not guaranteed an 8% return, but before we get paid, they're getting paid an 8% compounded annually return that's cumulative. So before we make any money, they're getting paid 100% of their dough back plus their interest. And then we also have done, you know, depending on what product it is, what the deal is, 25-75, it's gone, you know, 70-30, kind of all over the board. But so after everyone gets their money back, including us, because we're co-investors in all these deals, we make sure that all of our partners know that we've got at least 20% of the equity that's required. We put it in ourselves so that we've got skin in the game. So once all of us get our money back, our investment, our original investment, plus compounded 8% return, then it goes 25% to us, being the developers, and 75% in that scenario to all the investors, which also includes us. So it's a pretty straightforward deal. We take development fees when we're doing development, which is 90% of what we do. There is no asset management fee or anything like that. So if we're buying, you know, maybe we might take a, you know, a purchasing fee, but pretty straightforward. We don't over fee anything. So that's kind of the approach we take.
Yeah, and I think I would agree with Jim and Todd here on the structure of things. I mean, most of the business plans put together are pretty standard in that form, and I think it comes back to what are the investment objectives of you, right? Like, what are you trying to accomplish? I think assessing the sponsor, we're talking about track record, these are important qualities. If they're not someone like, you know, someone you know, then, you know, maybe their mentor is, or you can kind of, it's a relationship business, so you can usually find out those types of things on who are the bad players. Definitely just making calls, that's very easy to do. But I think really it's having alignment over what are the long-term investment objectives. We've always looked at cash on cash programs, and either growing the cash flow from the program and not expecting a capital event. In other words, if we know innovation is happening, if there are certain situations that are external that may be in our control or not in our control, if we held onto this asset, how does that asset perform? And so if you're aligned with somebody in a partnership or joint venture or some structure, you have to look at the incentives. In other words, they're going to be talking to you about, hey, we need to move on this transaction. There'll be fees on that transaction to exit, maybe missed opportunities. Maybe they'll hold back on certain improvements because they're not long-term holders of real estate. And so you got to look at the alignments. If they're incentivized to make money when there's a transaction, oftentimes that could be, as Jim stated, not so good thing if you're sort of sacrificing long-term cash flow. So I think it's really understanding, you know, how to look at the team. Is this team looking at the customer of tomorrow? You just heard Jim talking about even an Amazon. Anybody can tell you Amazon's great today, but somebody that's thinking about Amazon being like, hey, I'm looking at what could happen, that's the kind of thinking you want to look for in sponsors and real estate operators.
Some of the things that I think you got to be super careful of is there's a lot of products out there, and Jim, Todd, and Patrick talk about their products and their fee structures, which are quite unusual because they're incredibly low. And so really understanding the fee structure and asking questions around what are the total costs inside this particular fund, I think are critical. The cash flow element and the low leverage is very common amongst, you know, our three guests, and I did that deliberately because I've done business with Jim and Todd for such a long period of time. But when you all of a sudden can mix in, you know, 20, 30, 40% of your allocation into an asset class that generates a 6 to 8% on cash return, then that allows you to do a lot of different things inside your bonds and your stocks. You can actually diminish your equity exposure because you don't need the equity return. You have the cash return of the real estate, and so therefore it's such a tremendous vehicle. The problem is accessing guys like these are oftentimes very difficult because they're not out really raising money in any capacity. So parting thoughts from you two, three, while we wrap up?
Shoot.
I think it's a really exciting time. You know, again, going back to understanding, you know, focusing on where things are going, understanding the customer, and at the end of the day, that's who is going to be paying the rents of a lot of these real estate assets. So just paying attention to what's happening outside the world of real estate, and like Jim said, just focusing on local aspects to your portfolio.
I think it is a real exciting time for real estate in Arizona. Just with what's going on around the country right now, I think there's going to be a lot of opportunities in Jim's field. The industrial market, I think, is going to be a big beneficiary of the turmoil that we've seen in the United States, with people doing a lot of their shopping online now, and the grocery stores and doing the grocery delivery and all that. So I think it's a very interesting time for real estate.
I think as we look at this COVID thing, I really think we're in early innings. Everybody says it's over, and if there's a flare-up anywhere in the country, I think all these governors are going to go berserk trying to shut their economies back down. And I think, if you look at the asset class, hospitality, I'm not sure that is going to recover anytime soon. Would you send an employee to San Francisco for an hour meeting that he could do on a Zoom call? I think that's going to change. Office, the same. My daughter runs a big office building here in Phoenix, and a lot of these big national companies are looking at their space footprints and saying, hey, we don't need this much space. We might have our employees work 1 week in the office, 1 week at their home, and do Zoom calls with them. So it's changing before our eyes. And, again, I feel very fortunate the business that I'm in, because I think it's going to keep struggling through the summer. And, the multifamily business, which has truly been the darling, I felt like I've been left at the bus stop watching the money that people have made the last 10 years. But after the unemployment benefit shuts off in July, collecting rent may be tough. And now I don't know what percentage of those tenants are actually living on the unemployment benefit, but right now they're making more money in a lot of cases than they could make in their jobs. So it's going to be hard.
True story.
Well, thank you for being part of the summit. We really appreciate your time, Jim. Thanks for flying in and running from your car here. We really appreciate it. And let's take a 4-minute pause and let's reset the stage and let these guys be on their way.